Hello and welcome to our latest Insider interview. Today in the studio, I'm joined by James Thomson, Fund Manager of the Rathbone Global Opportunities Fund. James, great to see you today.
Yeah, thank you for having me.
So James, you look for companies that have a certain star quality. Could you explain what you're specifically looking for and name some stock examples?
Yes, we're trying to find companies that are flying under the radar. Their growth is underappreciated by the market. There's a star quality that they have that gives them resilience and lots of growth potential going into the future. We like companies that are doing something different. They're shaking up their industries, growing quickly but sustainably. But we also don't like to get involved at a very early stage. We prefer mid and large cap companies that can sort of repeat and scale up their product or their service. And I think that's really been the secret sauce to what we've done over the last 20 years. Examples of that, I suppose, would be companies here in the UK, like Rightmove, a business that we've owned since 2009, a company that does something different in that it's very difficult to copy what they do. There are lots of imitators, but trying to copy them successfully is very difficult. They have such a significant market share in the UK property market, but they also have a significant share of our head. We naturally think of Rightmove as the first place to go when we look to buy or sell a property. And that gives them incredible pricing power. Adding to that, they put in products and services into estate agents that help them do their jobs. And so that deeply ingrains them into the day-to-day function of an estate agent. Another company I would give an example of star quality would be a business like Visa, which is the credit and debit card network that we use every day. They too are deeply ingrained, a resilient part of the economy that's absolutely mission critical. As we still move from cash society to a card-based society, and that's more mature in developed markets, but in a lot of emerging markets, that journey is just beginning. They are the type of the company that really benefits from that journey. And so that star quality is so difficult to repeat, and that's what gives them a competitive advantage and growth potential going many years into the future.
There are hundreds of global equity funds available to investors. So how does your fund stand out from the crowd? What do you do differently?
Yes, you're right. There are lots of funds to choose from in the global equity space. I suppose what we do differently is that we have a good track record of performance. We have some good pedigree of stock picking skills in the market that has been refined over 20 years. And I'm proud to say that we're ranked number one in the country in the sector over that 20-year period with 1,000% return. I think sometimes also what you do differently is what you admit you cannot do, areas that you think you shouldn't invest in. And for me, that's not investing in emerging markets or Japan or in certain sectors of the market that I don't think have high quality growth credentials. So understanding what you're good at and what you're not good at, I think is an important differentiator in the market. And then finally, I think what's often sort of unspoken or underplayed is that I think we act with honesty and integrity. I'm someone that people can trust. I'm putting my own skin in the game here as well. I think honesty, integrity, and trust is vital in an industry that perhaps doesn't have much of it over many years. So I think those are all qualities that we can look to differentiate ourselves within the global growth space.
In terms of your top 10 holdings, I can see that there's 3 of the so-called Magnificent 7. You have exposure to Nvidia, Microsoft, and Alphabet. Could you talk us through the investment case for each of those and how each of those businesses are going to potentially benefit from advancements in artificial intelligence?
Yes, I think sometimes a maligned group, the Magnificent Seven, and you're right, we own 3 of them. In fact, we own 5 of them, not all appear in the top 10, but very much leading the charge in terms of advancing AI would be Nvidia. If AI is a gold rush, I would describe Nvidia as the picks and shovels for that gold rush. It requires 10,000 GPUs to make ChatGPT come alive, and each one of them is about $50,000 a piece. And so you can see just with one company how the scale opportunities of AI growing more widely can benefit a business like Nvidia. And yet this is a company that I think is still underweighted and overhated by a lot of investors. So even though it's had an incredible run over the last year and a half, I think it's one that's still very much leading this next era, next computing era in artificial intelligence. Analysts talk about computing eras in which one or two companies tend to dominate. And they tend to be vertically integrated. They have hardware and software and chips. And one or two companies tend to get 80 or 90% of the market. And as you move from one computing era to the next, it's usually a 10x revenue opportunity. So if you think about mainframes moving to PCs and then smartphones, and now this era of artificial intelligence, you can see how the size of the revenue opportunity for some of these key players starts to come through. Microsoft is another beneficiary, albeit not at the picks and shovels end, but actually in applications that people are using for artificial intelligence. And so their partnership with OpenAI and ChatGPT would be right at the forefront of that. But think about how deeply embedded Microsoft is in our businesses. It is a mission-critical software and applications that our businesses use every day. The idea of ripping it out is impossible. And now they're starting to actually embed AI features into the suite of applications that we use every day. Think about your Microsoft 365 products, your Word, your PowerPoint, your Excel, which are a key part of how most businesses operate. They're now embedding Copilot, which is an artificial intelligence application into that, which really generates potentially some significant cost savings and productivity improvements, and they're charging for it right now. So we're actually starting to monetize this AI opportunity. And then a business like Alphabet, which I think they're probably a little further behind in terms of the AI zeitgeist. Their product is Gemini, which is a generative AI application similar to ChatGPT, but I think it's had some teething problems. So they're a little bit further behind, but their core business of search, which obviously taps into the advertising world, there is a constant desire for advertisers to gain eyeballs. And so that's almost one of the last things you cut in your advertising budget. If you look more broadly within Alphabet's business, you've got businesses like Waymo and Google Maps, their cloud computing offering, and then YouTube. My daughter's personal favorite, YouTube. Over 5 billion videos a day are streamed on YouTube, and the monetization potential of that really is still in the early innings. I think probably it's easiest to hear from the chief executive of Nvidia, where we see the potential opportunity that lies ahead. And he says the new AI infrastructure will open up a whole new world of applications not possible today. We started the AI journey with the hyperscale cloud providers and consumer internet companies. And now every industry is on board, from automotive to healthcare to financial services, industrial to telecom, media, and entertainment. This is now gaining a traction in so many sectors, and we're really just in the foothills of the rollout of this technology.
So you've just explained that you've got some exposure to the US technology companies. In terms of on the risk spectrum, they'd be at one end. And then at the other end of the risk spectrum, I know you do have some exposure to some conservative businesses, as a portion of the portfolio is in recession-resistant companies. How much is in that bit of the portfolio at the moment, and could you name some stock examples?
Yeah, the risk of running a growth fund is that you get carried away. And you end up filling your portfolio with too many adrenaline-filled growth stocks. And I think what I realized many years ago, really after the 2008 financial crisis, was that you really need balance in a portfolio. You need a buffer, a defensive buffer, in case of a market dislocation or a recession or a significant change in the market backdrop. And so after 2008, we decided to put in a weatherproof part of the portfolio, less economically sensitive businesses that are still growing, but perhaps not the sexy growth of the rest of the technology, perhaps driven portfolio. At the moment, we have about 20% in this more defensive, weatherproof part of the portfolio. And examples here would be in companies that we've owned for many years. The first one would be a U.S. business called Rollins, which is a pest control business. And you can have defensive businesses that are not only selling defensive products, but they're also selling defensive services. And I think the beauty of a pest control business is, really sort of good economy, bad economy, the bugs don't care. And particularly in the United States, there is a pest control problem, and you get pest infestations in some parts, which is really why you need this essential service. And it has a repeat nature to its business model. And so I think that's something that always investors prize, that repeat level of business, which ends up giving them pricing power and real dominance in a market that's quite highly fragmented. Another weatherproof business I would point to is a U.S. garbage collection company called Waste Connections, which we've owned for many years. Again, an essential service. Things have to get pretty bad before you turn off your garbage collection. And in the U.S., that's about $35 a month. And if you think about commercial customers of garbage collection services, imagine you're in the midst of a recession. Well, if your bin is full or your bin is 3/4 full, sadly, you pay the same price. And so that really gives them a pretty powerful buffer during difficult economic times. And that's why you really see the resilience of a business like that coming through. So I think you can end up creating a quite exciting defensive part of the portfolio that acts as an excellent foil to the more pro-growth, more economically sensitive rest of the portfolio that we own as well.
You're a growth investor, but you don't want to overpay for growth. So where are you finding the best valuation opportunities at the moment?
Well, throughout my career, I've always found valuation to be more of an art than a science. And I've never thought valuation is a great predictor of future performance. But you're right. What you don't want to do is get sucked into momentum businesses that end up having totally unreasonable valuations that you buy into. But I wouldn't look at it the other way either. Cheap valuations are also not a great predictor of future performance. Just look at the Russian equity market, which is on a P of 2. Even at that very low valuation, I would say that's probably still overvalued. Compare that to the U.S. market, which is on a P of 20. That may look expensive, but I don't think it's actually overvalued. And so you always have to blend valuation with growth potential and resilience. And if you look at a market like the U.S., which is sometimes criticized as being one of the most expensive in the world, I think actually what you're paying for is something different. You're paying for innovation. You're paying for resilience and repeatability. And in many ways, I think that's worth a premium to the rest of the market. So actually where we're putting most of our firepower, over 2/3 of the fund, is invested in what people are calling one of the most expensive markets in the world. But as I've often seen over my career, expensive doesn't necessarily mean overvalued, and that's where I think the greatest opportunities lie.
And when you're investing in a company and hopefully it performs well, how do you decide whether to run your winners or take some profits?
Well, it's probably dangerous having mantras, but I would say one of my mantras is run your winners and cut your losers. And I think that often runs in the face of what a lot of investors do. But I believe that good companies often use their approach as a platform to continue to grow and use that platform to go into new markets, to expand the size of the addressable market that they can target. And so what might seem like a ceiling is actually just another floor. So we often believe in backing these companies continually. But that doesn't mean we don't change our minds. I think you have to be flexible and adaptable to changing circumstances. I remember early in my career talking to a colleague, and I showed him a sell note on one of his investments, and he threw it back in my face. He didn't want to read it. He didn't want to know. And I always remember thinking to myself, I don't want to be that guy. I always want to be open to what other people think. And that's why I surround myself with smart analysts, strategists, and economists who are giving me lots of different views and advice. And really, it's my job to filter that out and come to a final decision. But if the facts don't change meaningfully and we think the medium to longer term prospects are still intact, and the valuation isn't outrageous, then we tend to run our winners and stick with them over the long term. And I think if you look historically at the contributors to our performance, it's been the companies that we've owned for the long term that have driven most of the contribution to performance.
And in terms of running your winners, all things being equal, are there any companies you would highlight that you could never envisage selling?
I mean, I think never is a strong word, but there certainly have been a significant number of companies in the portfolio that we've held for over a decade. And I think it's hard to envision selling any of them, but I wouldn't say impossible. And I think if I have any skills, I think it's a willingness to be flexible and adaptable and change my mind. And there certainly have been examples of companies that we've owned for a long period of time where we have changed our view and sold out. But I think broadly you're right. It's the sort of portfolio where I think the core list of holdings that we have backed for a long period of time and that we really believe in is growing. I think a good guide for investors would be to look at our top 10 holdings. Those are companies that we've owned for many years that have grown significantly and earned their right to be in that top 10. And I would think it's difficult to imagine selling them, but I'll never say never.
James, thank you for your time today.
Thank you, Kyle.
So that's it for our latest Insider interview episode. Hope you've enjoyed it. You can let us know what you think. You can comment. And please do hit that like button and subscribe. And hopefully, I'll see you again next time.